So we're at the top of the hour, John, you can go ahead.
Okay. Good morning, everyone, and welcome to the Hudson Gateway Association of Realtors Commercial and Investment Division meeting for the month of September. We just got it in last year. Today's panel is going to talk about commercial properties and what is financeable in today's COVID environment. Transactions are certainly still happening, but how is the financing occurring? Is financing as readily available as it was pre-COVID? Our panelists today will give us information on what's happening. But first, I would like to introduce the sponsor for today from Statewide Abstract in White Plains and New York City, Matt McAllister. Matt has been working at Statewide Abstract in a production role and is a licensed realtor providing top service to the Westchester County market. This has given him an extremely in-depth understanding of title issues, which helps him provide exceptional service to his clients. Prior experience in financial management, strategic planning, process improvement, and research and analytics are a great benefit to Statewide and his real estate clients. Matt lives in Mount Kisco with his wife and Labradoodle. When he is away from the real estate market, he enjoys spending time with his family and training for ultra endurance races. I would add several transactions that I've recently participated in have done title work by Statewide. And as most of you know, title rates are standard across the board. The thing that makes title companies different is the level of service they provide. And Matt and his team have done exceptional work on some of my transactions recently. Matt, you want to say a few words?
Yeah, definitely. Picking up on that service-related note, that is a big part where Statewide shines. You know, we are a family-owned and operated business, started 40 years ago. So probably be a little too cliche to say we treat our clients like family, but that relationship definitely does bleed into our service. We've been handling commercial and residential across the board, and as the panel will get into a little bit more, we're familiar with the intricacies and challenges that are being faced in the commercial market right now. So we like to consider ourselves a partner with our clients. We're here to help you identify issues, get them cleared, and get to the closing table. So without further ado, I'll leave it up to our professionals here to get into a little more detail.
Thanks, Matt.
Yep.
Again, welcome to everyone. My name is John Barrett. I am president of the Commercial and Investment Division of the Hudson Gateway Association of Realtors. I also work as the managing director of the investment sales team at RM Friedland. With us today, we have a panel of 3 bankers who do business all over the Hudson Valley as well as New York City. We also have a mortgage broker, and I'll take my time now and introduce them. First, we have Lola Gazavoda from M&T Bank. Lola is currently a team leader, vice president, and managing a team of relationship managers with M&T Bank's business and professional banking group. Lola joined M&T in 2013 and has over 15 years of business banking experience. Prior to joining M&T Bank, Lola held other positions with Chase Bank and Capital One Bank. Lola was born and raised in Albania and came to the USA at the age of 14. And she's very proud of her heritage and gets involved with many of that community's nonprofits. She also gets involved with other nonprofits like March of Dimes and volunteers her time to help at the Bronx nonprofit Grace Outreach, which serves low-income women of all ages who seek to pursue higher education. She's a past board member of the Child Care Council of Westchester, as well as the chairwoman of the Westchester chapter of the VACTRA organization. She resides in Bedford with her husband, John, and their 3 children, Daniel, Nicoletta, and Julia. Next on the panel, we have Nick Mara. Nick is Regional Manager, New York and New Jersey, Senior Vice President, Business Banking at Webster Bank. Nick's role at Webster Bank is to oversee the sales production of 5 officer-level business bankers. He is responsible for expanding the Webster Bank brand into de novo markets through the development of centers of influence, product development, and community involvement. Nick has 20 years of banking experience, including 10 years at Webster Bank. He received formal credit training as well as training to become a certified cash manager from JP Morgan Chase. He holds Series 7, 6, and 63 licenses, as well as licenses in health and life. He studied for his certified financial planner license at Boston University and is in the process of obtaining his commercial real estate license. Also on the panel, we have Michael Spencer from TD Bank. Michael is a 26-year financial services professional who has underwritten, serviced, and originated everything from residential lending through venture capital. Michael is currently a commercial lender for TD Bank in their New Windsor location, servicing the Hudson Valley market. He has been employed by TD Bank for over 6 years, handling everything from managing an existing portfolio of clients, as well as bringing in new relationships via the SBA, commercial real estate financing, and C&I lending. Michael's career started back in 1994 as a financial services representative with Beneficial Financial based out of White Plains. During his career, he's held positions ranging from regional vice president of sales to team lead, underwriting manager as well. Michael also, for a period of time, was self-employed as a commercial mortgage broker through Admira Partners, focused on bridge, venture capital, conventional, business loans, and not-for-profit equipment financing. In his spare time, Michael enjoys exercise, cooking, and spending time with his wife and 2 kids who live together in Cortland, New York. Lastly, on the panel today, we have Robert Withers of M1 Capital. Robert is a highly accomplished real estate finance professional with a superlative record in providing creative financial solutions for his clients. With over 30 years of experience in the real estate finance industry, he brings a seasoned veteran's perspective to his clients' needs. His opinions, insightful information, and bylined articles have appeared in the New York Times, Westchester Journal News, the Wall Street Journal, NBC, and CNN, as well as local news radio. So that's our panel today. We've got 3 bankers and a mortgage broker. So guys, tell us a little bit, how is the market different today than it was pre-COVID? So from my perspective as a broker, there was a definite slowdown in activity in March and April as people were not focused on doing business. We were concerned with the spread in the region. New York was a hotspot back then. Since then, beginning in June, when we started reopening, transactions have started moving forward. Transactions that were in the pipeline have started moving forward. New transactions are happening organically as well. What do you find the lending environment to be in any aspect of what you're lending right now? Anybody?
So, John, it's Robert Withers. I can tell you from our perspective as a mortgage broker that it's been very spotty. We are doing business, but it depends on what you're financing. I will hear from the other panelists, but it's our experience at M1 Capital. We're very active in the multifamily and the mixed use segments of the market. And right now, everything seems to be surrounded or focused on government-backed lending. So on the multifamily side, it's the agency financing that we're finding is moving because of the high leverage that you're able to get, 80% through the agencies, Fannie and Freddie submissions and applications. And, that helps, obviously. Also, what you get with the agencies. They really haven't changed their debt service coverage ratios. And on the other side, when it comes to the mixed use retail side, it's if it's owner occupied, it's SBA financing. I'll leave the other segments of retail and mixed use, and obviously anything else that the other speakers want to jump in on to comment on. But we are seeing a lot of activity right now on the multifamily and SBA based loan requests.
Lola, are you seeing the same
Yes.
thing?
So John, thank you, and thank you everybody who's on the phone this morning for listening to us. So one thing that I wanted to talk about M&T Bank, to tell you the truth, we're definitely lending, so we're doing quite a lot of business out there, and I wanted to note that there are no boxes within M&T Bank, and we're really focusing on common sense lending. So what does that mean? And we know that everything can be mitigated, which means that, for example, you have a deal in one location compared to another, and it'll get approved based on the knowledge that we have on that location. The same could be for the same deal with one guarantor compared to another, and we're approving them based on the strength of the guarantor. We are doing, in business banking, which is up to about 5 to 6 million exposure, we may be able to do non-recourse lending. But again, it's a case-by-case situation. And we may be able to do 30-year amortization, again, depending on the deal. And we simply have the expertise within the bank to know our market and our customer, and we look at each deal individually. So anybody on my team or anybody on the phone who comes to us for a deal, the answer is not a box, but it's more of, let's look at the full financial package. And we're being creative with each one of those deals. And we're definitely doing deals, let's say a CRO financing, condo financing, not-for-profits, obviously owner-occupied, industrial. We're seeing a lot of multifamily, even religious organizations. So again, we definitely are lending. And when you think of us, just think of not boxes, but more of common sense and relationship banking.
Nick, what are you seeing in the market?
John, first, thanks everybody for jumping on. I hope this is insightful for everybody who's tuned in. What I would say is that, obviously COVID came, right? And it's had its effect, and every bank has to look at things a little bit differently. I don't think any underwriters at any bank have ever been prepared for a complete shutdown of industry across the board. So nobody could underwrite and prepare for that. But I think what we've done now is come out of this thing a little bit, and we have a chance to breathe a little bit and reassess what's going on in the marketplace. And as such, we sort of looked at things from the perspective of, and if you're somebody coming into a bank looking for a loan right now, you have to talk to your banker about how COVID had an impact on either your tenancy or your business itself, right? Even if it's real estate, if you're not a large holder of real estate, meaning that you're a portfolio based lending company, real estate company that's holding multiple parcels, and that's your business, that's a different set of circumstances. But if you're a business owner that also owns a few parcels of real estate as investment for future use or current cash flow, you want to talk about how the property, how your tenancies were impacted. Did your tenants pay through this whole crisis? Was there a shutdown? Is your tenants currently paying? Things along that nature. We also, just like any other time, I think you appreciate liquidity more than you did before in certain circumstances. You want to see a client with liquidity that can bail themselves out of certain situations if a tenant isn't paying. Obviously, history and knowledge and being in that game for a long period of time means something to everybody. It doesn't mean that you started investing 2 or 3 years ago. That you've gone through a couple cycles is always an important piece of the puzzle. But there's not a business that didn't have some sort of COVID-related issue, and tenants have had COVID-related issues. So the best part is to tell your banker what actually occurred and how you were able to handle it. And, if you needed any kind of deferment or you were able to pay your mortgages as agreed through this whole crisis, because character is going to play a huge role in how banks look at clients more than ever. So, there is changes. We can't sit here and say there are none, but we're still financing. We're doing a lot of financing. It's just, you want to be better prepared as a client right now. When you come into a bank, it's not a free for all anymore. It's, hey, what happened? How did you handle it, and what kind of position you are in to handle future issues if they should arise? And that's what I would say.
Michael, would you like to tell us how things are going at TD?
Yes. Again, thanks for having me this morning. And just to kind of, echo, some of the things that Nick and Lola had mentioned there is, we are actively lending. Our footprint is mainly through Florida. Myself, I sit in New Windsor, so I'm kind of the Hudson Valley, Westchester. I'll do some stuff here and there in New York City. But like everything else, it's more of dotting the I's and crossing the T's. I mean, the days of looking, for example, at a personal financial statement, and I'll see, 1.1, 1.2 in cash. These days now, can I get a bank statement? Can I get an investment statement? I just want to make sure, you've had that cash. The cash has been seasoned. Kind of a global, holistic approach like the residential side. We want to make sure, people are who they say they are. Gone are the days of someone with an REO schedule, 10 to 12 properties on their personal tax returns are showing less than $30,000 of income. Their PFS is very light. I think those days for now are over, and it probably got too far going in that one direction. Now we want to see that you have the wherewithal should something happen. Do you have liquidity? We're using liquidity as a means to write more business. If we have to perhaps add a liquidity covenant or some sort of debt coverage reserve to a deal, we want to do that. We want to write business. We want to write business that makes sense. We're paying closer attention now to your, what's within your management fees number, what's within your, the vacancy number there. We might add a percentage point or two to that in this COVID market. We also want to see, our debt yield. What's your net income on your loan size? Is your debt yield, hitting our minimum hurdles these days? So now so again, just more, the narrative for us is more dotting of the I's, crossing of the T's, and seeing what we can do to get a deal to go.
Okay. So for the bankers, just so we understand your perspective, are all three of you balance sheet lenders, meaning you don't sell your loans off for the most part?
Yes.
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 Nick? Okay. And are all three of you, if you are lending, I think what I heard before is, communication is certainly key, but are you looking for the total relationship where borrower's whole financial picture?
Yes.
Definitely.
Yes.
Okay, good. All right, now, quick question, quick poll here. If you know, of your book of loans that you manage, what percentage ask for forbearance in March or April?
I'd say for myself, about 15-20% of my book, they were looking for it. I mean, they know it was there for them, and they've asked for forbearance, about 20%.
And are you extending that 3 months at a time, looking at it again at 3 months from
We
now,
have,
or did you give a longer period?
we had initial 3 months, and now we're on that second 3 months. That's where we are right there.
Nick or Lola?
John, I would say that, obviously looking at investors, they jumped on the chance for forbearance, and we had quite a few forbearance. I'm not sure my percentage in my portfolio. I don't think it was extremely high. I had a lot of clients that opted not to, but I think a lot of them took it out of precaution, not knowing that what was going to happen. But then, and we did generally 6 months. After that term period, I think I've only had one client, maybe two, request another 3 months. So I think we've seen a positive lift. I think a lot of the panic part was in the beginning, and we've seen a little bit more sort of getting used to the new environment, if you will.
So my team was pretty proactive in reaching out to the clients, even if they didn't request this. So, again, back to that relationship banking piece where we talked about the availability, and some took it just because it was available. So percentage probably is a little bit higher to what Michael said, but it's we're taking it 3 months at a time. So right now they're on that second, third month piece.
Okay, so that kind of leads into my next question. You've got a client who you've got a great relationship with, 5-10 years. They've been a great citizen. Their financials are always intact. They make their payments on time. But unfortunately, due to no fault of their own, they haven't collected rent for 3 months, 4 months, 5 months. And if you're in a multifamily building of 40 units and you're collecting, I've had clients tell me they're collecting somewhere between 40 to 50% of their rent in multifamily buildings. And I think, you know, the market is certainly bifurcated somewhat. So if you own a luxury building where a 2-bedroom is renting for $3,500 a month, your tenant in that building is probably working from home and still getting a full paycheck, and they are able to make their monthly payments. However, if it's a B-class building, hardworking people who've unfortunately been laid off, furloughed, or had their hours cut, and you're only collecting half your rent, what do you do with someone like that at this point? I mean, can you do anything more than forbearance?
John, I can answer in the sense that, I mean, obviously forbearance. Look, Webster Bank has never been the bank to put our foot down on somebody's neck when there's issues. Even during the last recession, we kept people in their homes. We don't want real estate. No bank wants real estate, right? We're not great real estate managers. We're not going to get top dollar if we take people's real estate back. We want to keep our customers paying, and we understand there's a lot of this is out of our customers' hands, right? You can't expect, you're not going to be able to get money from somebody who doesn't have any. I mean, obviously having strong liquidity, we base a lot of our decisions on that. And we base that decision because we expect that, especially if it's investment real estate, that the owners can step up to the plate as well and obviously help to bridge that gap between cash flow shortage. That's the difference between being a smart lender, is that you're lending to people that are not overextended and that can jump in and take care of their obligation. Now, we're going to meet them, right? And we're going to help them. And we obviously think that these properties are going to stabilize at some point or another. We just don't know what that stabilization is going to look like yet. But we're not going to be quick to pull the trigger to some default where we're going to be charging clients excessive amount of interest, hoping that they'll find another bank to bail them out. That's not what we're looking to do. We'll work with the customers. We'll talk to them. The key to the thing is communication on both sides. The customer has to be willing to tell us what's going on honestly and reasonably, and give us that insight to what's going on so we can work together. The best thing to do is communication. If a customer just shuts down, it makes it much harder. But if they're willing to communicate, tell us what's going on, you've been a good customer, you've been a performer, we'll figure something out.
Anybody else want to add to that? Okay, Robert, let's move over to you. What has been the impact of alternative lending in the commercial capital markets through the pandemic?
John, first of all, thank you again for inviting me onto the panel this morning. And I can tell you that they've taken quite a hit. Most of the alternative lenders that I worked with during the pandemic ran for the doors. I can name a half a dozen that shuttered their doors. I work with 3 types of lenders. I work with private money lenders or private equity real estate funds. I work with alternative lenders like we're talking about right now, and then the conventional lenders like the represented by the panel here today. And for the most part, that middle tranche of lenders just ran for the doors. Like I said, they are mostly selling their loans in securities and in security-backed investments. And what basically happened is they were concerned about valuation. What is this asset worth? What are we lending against? And their investors and their warehouse lenders that they use backed out on them. So they, quite frankly, had no way to lend. The esteemed panel that you have here, by the way, I work with every one of these lenders on the panel here. And to the point that you just made before, I have seen every one of these lenders step up and work with their customers. So I've seen it firsthand. They picked up the slack. They jumped in and probably lent on what was left of that market for those transactions that were going on during the pandemic, and made deals happen. So my hat's off to them.
All right. Staying with you, Robert, what's happening with CMBS right now? What's that market look like? I mean, I'm starting to see some default notices, especially on some of the retail and hospitality.
Yeah, specifically retail and hospitality, John. Good question. It's taken a major beating. It's scary. There's, those loans are much more difficult to work out. You can't pick up with a CMBS loan. You can't pick up the phone and talk to a Nick, a Lola, or a Michael, right? So they're intrinsic. They're just because of the way that those loans are set up. It's more difficult. Wells Fargo did a study, I think it was last month. Last month in August, through the Financial Times, that right now, they value their properties. The appraisals that came back on a lot of these CMBS loans that were in default, and there were about 116 CMBS loans that were in default at that time. Okay, 106 of them, their appraisals were 30% less than what they had been appraised at when the deal was done. So the impact of COVID to loans that were made and sold into a collateralized commercial mortgage-backed security was impacted to the point where now, where they were maybe a 60% loan to value, they're at a 90% loan to value, which triggers all sorts of default covenants.
So going off that, Robert, do all of the other panelists agree that prior to COVID, market fundamentals were good across the board for all asset types?
Are you saying that the banking fundamentals, what we would lend on?
I'm saying the fundamentals of the underlying real estate assets. So the market was pricing in line with value for multifamily. Was it in line with value for industrial properties prior to COVID?
I would.
Oh, go ahead, Michael. Michael.
I would say yes, up until retail. We were getting some reports, with what's going on with, Amazon, things being delivered door to door. We were having a little skittish on retail even prior to the whole pandemic. So I would say that one class right there, retail being defined as not your local mom and pop, barbershop, nail salon, more of your chain sort of, I don't know, dollar store, a Macy's. So we were a little bit skittish on retail prior to the pandemic.
You thought the fundamentals of the other asset classes were in line with value?
I believe so, yes. The only one that that stood out for us where we kind of had some pause was retail.
John, in my estimation, I had felt that the multifamily market had reached a point of a sort of absurdity, and it was probably a mixture of both the banks and the rush of following millennials into the city and such. Once banks start financing at 80, 85% LTV with limited or no recourse and very low margins, you run into these problems where comps come in and values keep going up, and you're still lending in those parameters, and you reach a point where you really can't take a step back because you've already maxed out your LTV and you sort of maxed out where you think rents could be. So now you're in a position, right? Your margins are thin. You can't really cut your rate to help cash flow. And I think out of all of them, because retail is always can go with the marketplace. No banker anticipated COVID coming in and shutting down every retailer. you can't anticipate that. But, and commercial warehouse and industrial to me was always my favorite asset class anyway. But multifamily, I think really, especially in Brooklyn, Manhattan, and all these areas, I think a lot of banks were betting on that horse heavy. And I think there was a very big, the numbers, stuff was trading at below 2 caps, and that's just absurd. And I think that market was really frothy.
So I would add on the multifamily that the rent laws that came down had a huge effect on what the values of those apartment buildings, especially in certain territories, right? In New York City, more specifically the Bronx, where the values just went down significantly because of those rent control laws that came into play, and that was pre-COVID, obviously.
Real quickly to the bankers, what asset class do you like the most?
That's a loaded question right there. I say that we like the ones that perform. We like the ones that are going to pay and perform.
Strong balance sheet, good guarantor. Come on.
Yeah. We need to see, cash, strong collateral positions. I would say, one of the things that I'm seeing now, a few of my realtors, they focus on the triple net space. I think, John, we had talked about that briefly yesterday, and we're talking asset sizes, $2, $3, $4 million. Usually these folks are in a 1031 exchange. They'll put down 45, 50%. Yesteryear, prior to the pandemic, that's probably a non-recourse type of transaction for us. But now with where we are, we do want some sort of limited recourse with that. But when you have a sponsor, putting in 45, 50% into a deal, your debt yield is going to be strong. Your debt coverage is going to be strong. If it's, a triple net situation where you have a corporate guarantee, we're still demanding to see, liquidity from the sponsor. That's a better deal for us. I can't build a book of business just doing triple net deals that are, $2, $3, $4 million bucks. But right now there is some, we're getting some of those done. And those, again, because being in the 1031 exchange, just plopping down that much cash, all the matrices, they just look good. So it's working with that right now.
Lola, what deals are you looking for? Somebody comes to you looking for a loan, all things being created equal,
I mean, so in my team, we're in business banking, right? So it's not on the commercial world. We have our commercial team that may focus specifically on the larger, very creative, non-recourse kind of deals. I mean, in my world, we'd love to see, owner-occupied, serial loans, condos, just more definitely looking at the strength of the guarantors and on a global basis, really underwriting that way. So.
Okay. And I think, Nick, you indicated before you like the industrial, you've always liked the industrial warehouse sector. Do you feel that that's the one asset class that may have legs now to run?
Well, I think we're seeing it right now, an exodus from the cities to the suburbs. I mean, prices of real estate in Connecticut, Fairfield, and Westchester are going crazy on the residential side, right? And with retailers shutting down, the need to have product same day even is going to keep expanding. And to me, I think warehouse and light industrial is just a great asset class. Nobody's building warehouses, well, unless you're in Jersey. So it really comes down to it's just a stable, strong business to be in, for me anyway. I've always liked it, and I think it's going to be successful going forward. I think there's still room for growth in that segment.
Okay, good. Robert, what's been the impact of the federally backed loans, Fannie Mae, Freddie Mac, SBA in today's capital markets? It looked back in May and June when the SBA was funding certain loans that had passed the federal government, that they were bogged down. Are they now moving quickly to do the typical, what is it, a 504, SBA 504 loan?
7A and 504, yes. Like I led with in our discussion today, John, I'm finding the most success depending on the asset class in both of those places. I don't want to call them buckets, I want to call them solutions. Both of them are great solutions for somebody who, if they have a multifamily property that they want to finance and get the best pricing, Fannie or Freddie, a good Fannie or Freddie lender is where we'll take them. The biggest issue right now with the with federally backstop loans, and you're going to see this across the board. I mean, I'm sure all the bankers would agree, is the reserve requirements, the debt service reserve requirements. That was the biggest impact. I mean, you know, depending on whether or not you're going Fannie or Freddie on a multifamily deal, you could be anywhere between 12 months and 18 months worth of interest, debt service interest reserves that they want to see and that they're actually going to hold. On the SBA side, you may see that also. On the owner-occupied SBA loans, you'll also see that. Obviously, SBA is for owner-occupied transactions. You have to have 51% of the property occupied by the owner. But again, the solutions are nowhere. You're not going to find a solution. I haven't found a solution like that for the leverage that you're going to get up to 90%, the closing costs that are going to get covered, and so forth and so on. But yes, they are drilling down on, as all the panelists said, they're drilling down on the integrity of the leases. They're drilling down. They want to know who they're lending to. What are those, you know, they may even ask for financials for the tenants. Well, and certainly on an SBA side, they're going to, because it's part of the transaction. So the impact of COVID on the agency lending, both on the, on agency lending on the multifamily side and SBA on the owner-occupied government side, I would say has been the need for liquidity. They want to see, as all the panelists have said, they want to make sure that, 6 months down the line, if there's an issue in regards to rents, whether or not you're paying yourself rent in the case of an SBA loan, or your rents with a multifamily, that you've got the liquidity to be able to stay the course.
What's the extra time horizon to close a loan if you're doing SBA versus a traditional loan?
Yes, I didn't address that question. I'm sorry. I would say they're probably right now coming back to what was norm. I'm closing SBA deals within 60 days, 60 to 75 days, depending on due diligence. Same thing with any agency loans. I mean, they're more complicated loans. The paperwork is more voluminous. There's extra steps in both of the loans. But that's what we, quite frankly, as a company, that's what we specialize on. We specialize in. We help the borrower get through that process. So we're a little bit back to normal now, whereas I think things were elongated, time frame was elongated, and that had a lot to do with the fact that our lenders, as I'm sure all the panelists had gone through, was servicing their clients. The PPP loans were taking up, I'm sure, most of their time, as I can tell you, most of my other lenders' time. So
this is a good time for me to announce that if anybody has any questions, please put them in the question and answer box that will appear if you hit the Q&A at the bottom of your screen. We just had a question come in, and it's relative to the SBA, and it's from a broker. And he says, our buyer feels that the SBA funding fee is very expensive for a 7A or a 504 loan. Does anybody have any feedback on that?
Give some feedback on that. Obviously, the 7A is going to be a little bit more expensive than the 504. As a 504, basically the loan is being split between the bank and the CDC. So 50% of the loan goes to the bank, 40% to the CDC. They're basically charging a fee, but that fee in New York would typically be absorbed by the fact that you're not paying recording tax on the SBA portion. So it's sort of a wash, and they can also embed a lot of those fees into the loan, which typically gives you more of a 92 or 93% financing. The 7A is a different loan. That's where the bank is actually getting the SBA guarantee on their loan. So we have to pay for that guarantee. So it depends on the size of the loan because that fee can be up to 3%. Typically speaking, a 7A loan should be really used for, in my estimation anyway, a lot of business purchases, but also smaller transactions. If you're buying real estate or a larger transaction like that, a 504 to me is more appropriate, given the fact that you're not paying that 3% fee. Also on the 504s right now, you're getting 25 years fixed from the SBA, and I believe their rates are below 3%. So you're almost in the 2% range on those 504 loans. Couple that with the fact that right now most banks are, and we are too, matching that 25 years fixed. You know, it's very hard to say that that's not a great way to go right now to get your financing. And to me, it's been no faster or slower than traditional financing right now. The only thing that could hold things up right now is sometimes municipalities shutting down and whatever and getting that information, but that's been very quick. And now that the IRS has opened up, getting tax transcripts have been very quick. So we're seeing good footings as far as SBA 504s are concerned.
You have a desk inside your lending area that processes the SBA portion of it that's different than the traditional application to the bank?
Yes, on the 7A side. So like I said, a 504, the bank is really just taking a traditional approach. We're in a first position mortgage. The SBA takes a second position mortgage. So really, it's not a traditional SBA loan, if you will. On a 7A, it goes to our SBA group that works with the business banker. That is an SBA loan, traditional SBA loan in which the bank is buying the SBA guarantee and applying it to the loan. So yes, we do have our people inside to make sure that we're following SBA protocol, but we are an approved lender by the SBA, which means that you know, if we approve things on the 7A side and the Express and the Capital, it's going to be rubber stamped by the SBA, so to speak. And so we don't have to wait for it to be sent out and hope that the SBA approves it. Generally, they're going to go with our recommendation for approval.
Does anybody else want to add to that? All right, let's move on. How have deal metrics changed from January 1 of this year, pre-COVID, to now? In other words, looking at debt coverage ratios, reserves, how are you underwriting for vacancy and credit losses?
I'll start there. I mean, with, you know, traditionally speaking, if we had, I don't know, 3 to 5% with vacancy or 3 to 4% with management fees, we're adding to that a bit. You know, we might be 7, 8, 9% in vacancy, depending on the asset type. We'll add a bit more to management. Our debt coverage ratios, they're still in line. We're, you know, we want to see a higher debt yield, and sometimes to see a higher debt yield, you're probably rolling back with regards to your loan to value. So if our loan to values prior to COVID, let's say 70, 75-ish, maybe that's a haircut 5 to 10% in this market. On a case-by-case basis, but, you know, I think to the narrative we all had earlier in the hour here, it's just, let's look at each transaction, you know, does it stand on its own, and then does the sponsor behind the transaction, can they hold their end of the bargain here? Can they show us liquidity? Do they have a secondary means to you know, get this debt satisfied should the asset run to issues?
Nick or Lola?
I was going to add just one additional thing to what Michael just talked about. We're also stressing that the cash flow, and, you know, with more than just say 5 to 10% vacancies, what does it look like at, let's say, 15 or 20? Will it still support the debt that it has? And, you know, that obviously tagging along with the guarantor and so on, and the strength of the guarantor, those are the kind of things that we're looking at right now.
I would just add that, you know, one thing that we're going to do that's a little bit different than previous is we're going to want to see some history of rents being paid as agreed. That's probably going to be a little bit different than before when we just get a copy of the lease or a copy of the rent roll and we're satisfied. We're going to want to see that that rent has been paid. And I think clients that have month-to-month tenant bases are going to be underwritten a little bit different than ones at long-term leases. So it really depends on the structure of the real estate being financed, and what everything looks like is how we're going to stress it. So if it's more fragile and more subject to rent fluctuations, we're going to probably add a little bit more vacancy factor to that. If it's more stabilized with a better class of tenant, then you don't have to maybe stress it harder. So I think it really just matters what the asset we're looking at, and what the tenancy mix of that asset is going to depend on how we stress that.
And John, I mean, definitely location matters, right? So we're obviously property, like I mentioned, based on the rent laws in the Bronx, we're looking at very differently compared to a property, for example, in Westchester or in Fairfield County. So it really matters, the location and knowing what's happening there.
Good. We've got another question from the audience. Good morning. He's working on a gas station deal right now. Are people lending on gas stations? So that's obviously owner occupied. That's a good thing. There might be environmental concerns. There might not. How would you lenders look at somebody approaching you for a gas station deal who is not somebody who already owns 30 or 35 gas stations? For purposes of this question, let's assume, this is the first or second gas station this individual is buying.
Yeah. We're definitely looking at those packages. I responded to the gentleman. I said, yeah, definitely. Let's look at the financial package. Look at, again, I'd hate to give a box, but let's just look at the full picture and then see where we get to. I mean, we're definitely lending to gas stations as well.
Yeah, John, I did. I responded also to that person who asked asked for information regarding a gas station. I would tell you though that they're a little bit more difficult to do. I mean, they are doable, but as Lola will probably agree, you have a whole host of other issues that come into play with gas stations. The environmental piece is huge. The operating history of it, because you're also looking at the business. It's not just a real estate play. So we definitely have lenders who will do piecemeal gas station deals, but it's got to be the right deal. And as Lola also said, full package, underlined. So
to the bankers, I think the whole audience heard you loud and clear when you said every situation is unique, every building is unique, every borrower is unique. So you need to understand the whole picture. So if we have a property in a great location with a great operator, and you've got the total relationship banking relationship, where can brokers expect rates to land today? With what kind of amortization? Let's call it, let's look at 2 or 3 different scenarios. Let's look at a multifamily stabilized in Westchester. Rent collections have been 85% even during COVID. Where might you guess a rate would end up today?
I can take that. It's fine. I hate to always say it depends, but it really does on the investor, because we could do a ton of different things, right? A lot of times we have investors that we kind of call long-term strategy investors, in sense that they're making enough capital right now. They're not looking at the property as a cash flow for them right now, but they purchase that property for future rent considerations, whether it be for themselves or even the next generation, right? They might want to take advantage of a long-term fixed rate, which I can do through a swap transaction, which could fix a rate for 20 years if possible. Or at least do a 10 with a 25-year amortization, or even a 30, depending upon the asset class. Then we have other investors that are looking more, hey, I have super cash flow coming from this thing. I would rather a short-term rate where I can bulk down principal payments and really get this thing where I want to get it to for current cash flow considerations. But overall rates are extremely low. I mean, we're not going to see. I would say you'd be hard pressed to find rates that are above the 3s, on a long-term fixed rate. situation. But like I said, it really depends. We like to sit down with the customer and figure out what their strategy is, and then build the loan package around that strategy. Because the last thing you want is a client taking a 20-year fixed rate and then coming to you 5 years later and saying, oh, but I didn't want to hold this property that long. This was really a short-term play for me. Well, you know what? We got so caught up in discussing the rate and going out long-term fixed, we forgot to take into consideration what your overall investment strategy is. So investment strategy plays into it. But either way, you're not going wrong on rates right now. If a bank's going to lend to you and they feel you're capable of performing and the building is solid, you're getting very favorable rates right now.
On the situation you just described, would there be a penalty on that if he was looking to get out of the building after 5 years? Or is that just, it's disrupted your bank's plan for the investment?
Well, without getting too into detail on swap transactions, which can be a very lengthy conversation, the nice thing about a swap is you have to consider that the bank's paper underneath it is variable, and the swap is a contract, which means that it's assignable, assumable, and that assumability makes it a very interesting product where you can take a long-term fixed rate loan. And look, if you're going to sell early, you're probably going to 1031 exchange. If you 1031 exchange, a swap can follow you with that property. So it follows the 1031 to the new property. So theoretically, you don't have to pay that off even if you're out of the money. So it is a very nice product, and one that I typically like to talk about with all of our customers because the rates are a little bit lower than FHLB and Treasury, and it's also very portable, which is a nice, unique feature of the product set.
Does anybody else want to add to that?
I was just going to add that, there's a lot of variables that go into the pricing model that we use, which includes even things like deposits, right? So what are those deposits that are coming over look like? What's the personal strength of the guarantor? Where's the risk with that? What's the LTV of the property? Even as things like, merchant services or treasury management, depending on what that revenue looks like for the bank. So all those things, again, there's a lot of variables that go into the pricing model that then we're able to kind of sit down and talk to the customer. And at the end of the day, if it's a win-win for both sides, then we got a deal and we're moving on. But a lot of variables, unfortunately.
Michael?
Yeah, I would just say, my thought first is let's see if we have a deal. Let's see if we have a deal that the bank likes, the client likes. To Nick's point, to Lola's point, rates are very, very low. I mean, low, mid 3-ish, sometimes sub 3, depending on if it's a swap situation. We do those here as well. So let's get a full package. And just to go back a bit, when Robert was talking about time and process on deals, you're talking 60 to 75 days. Let's get a full package up front. Let's get a full package up front. So when we get to time for us to price it, that's not going to be a big hurdle for us. Let's first make sure we have a deal that's structured, that makes sense for the bank and makes sense for the client. Rates are very favorable.
All right, good. Let's wrap up. I don't see any other questions out there. So let's wrap up, and I'd like each of the panelists to just give us your view of the market. And if you want to, give us a scenario if there is a vaccine in 2 or 3 months, if we're still with the same pandemic and it's no better 9 months from now, what do you see the lending environment like? And even if you want to comment on the commercial real estate market, what do you see that like?
I would say that there's when I look back, let's say a month, right? There's a lot more activity going on. And I feel like that people, especially in our market here, they're just, they're ready to see if they can move deals along, especially in the real estate. And again, maybe in Westchester or Fairfield County and so on. So I think people are kind of fed up of what's happening, and they're ready to start doing more business than, let's say, a month ago. And I think that's going to be improved with the time as well.
Back to school, back to business, all in September. Anybody else on your view of the market going forward?
Well, John, I would say this. I wish I had a better handle based on what happened last night, but I don't have a handle. So I'm not quite sure where things are rolling after last night's debate there. But that being said, you know, I think the bank, there'll be some conservatism. You know, even as if we come across a vaccine, or if the curve continues to go back the other way, flatten a bit, there will be some conservatism. There will be a little bit of pause with getting to certain asset classes, as we talked about, you know, the multifamily in the city, the retail stuff. So there will be some, you know, it'll be more of a global, holistic approach with regard to dealing with current customers and prospects. We definitely need to know, you know, who we're dealing with, you know, today and going forward. I don't see that changing per se anytime soon. I would think Lola and Nick would probably agree with that as well. It's just more of knowing who your customer is there, and it's going to be that way for a while.
John, I would say that obviously until the election's over, there's probably not going to be much change going on. I would say this year is probably what you see is what you get. I think what you're going to see is if there's more of an understanding of COVID and what it's going to look like. I think once there's some sort of stabilization globally, because everything is impacted globally now, I think what you're going to see is a significant amount of merger acquisition type of transactions coming up, whether it's banks, medical practices, law firms, businesses, you name it. I think there's going to be consolidation. I think when people can breathe, I think some folks are going to look at that as a time to say, you know what, I've been doing this a long time. Let me cash my chips in now and maybe retire, or you know, a significant size of the population in small business is owned by older Americans. And I think you're going to see a result of that, of a lot of that type of activity across the board. I just think a reduction in managing your expenses and things like that are going to play into that. So that's going to play into the merger acquisition piece. But there's going to be a change in the landscape, technology, and we sped up that whole process, right? I mean, if we thought people were going to be using the internet to do commerce and it was going to take 10 years before it really had a major impact, well, that's just been sped up threefold. So I think there's going to be a lot of that going on, and companies that can position themselves through internet commerce and being able to do business remotely and all this other good stuff are the ones that are going to come out on top and figure out a strategy for moving forward and being profitable.
Hey, John, I echo all the words and thoughts of the panelists. But the word that jumps out at me most is what Nick just mentioned, and that's stabilization. I think, you know, the markets need to see that. They need to see certain metrics within the within the market stabilized, rent collections, defaults, you know, things of that nature. I'm personally very worried about, you know, we talked a little bit about the CMBS market. I'm really worried about that. I think, you know, that really affects larger projects, you know, cities like New York, where, you know, a lot of those loans are back, you know, like larger skyscraper office building type loans, along with, you know, huge multifamily projects. You know, that's worrisome, because what's happening to, you know, a lot of these larger developers are going belly up on their CMBS loans, but yet they're another part of the company is looking for new acquisitions and new opportunities. So I think stabilization is important. And, you know, one of the segments of the market I'm excited about, I'm starting to see some life in, is the construction part of the industry. You know, we didn't talk about that at all today, but, you know, that was worrisome because obviously, you know, the delay in pulling permits and things of that nature. But I'm starting to see a little life in that. So hopefully next year we'll start seeing some construction.
Quick question on that. Are you seeing the cost of raw materials, timber and steel, rise significantly?
John, personally, I don't. I mean, I don't really get involved in that, but I haven't seen much of a change in that. Or let's put it this way, I haven't heard any of the builders that I work with haven't been squawking about it. That's the best that I can do. So,
Nick, your feeling on that?
Well, as a guy who just had to fix his deck himself, you know, with the COVID shutting down a lot of the factories and such out and mills and things, pressure treated lumber, for instance, which used to trade at $16 a board, is probably trading closer to $37 a board. And it's not because people are just building decks, right? That's not the reason. The reason is supply and demand. And the supply chain has been, this is one impact that COVID has had, and it's had on industries all over the place, whether you're selling motorcycles, boats, whatever you're selling, getting that product back to fill your shelves is extremely difficult right now because there's a complete delay, whether it was at the factory level or even the trucking level and shipping level. There's certainly delay, which has caused prices to spike. So that is definitely going to have an impact on construction going forward, and especially if there's another winter COVID type of outbreak that could really be a backbreaker for a lot of product services like that.
Well, let's hope not. And I want to say thank you all to all of the panelists here today. You've all done a tremendous job offering your insight to us, and we thank you for spending an hour with us this morning.
Thank you, John.
Thanks, John.
Thank
All
you.
right.
And to the rest of the panelists. And to the rest of the panelists. Thank you.
Goodbye.
Have a good one.
Thank you.
Bye, everybody.
Bye.